Okay. Good afternoon, everyone. It gives me a great pleasure to welcome you all to yet another insightful session of the Brain Gain Expertise series organized by the Accounting Standards Board of the ICI. We sincerely appreciate your continued participation as we focus today on a fundamental yet often intricate area of financial reporting, understanding the nuances of inventory valuation. This 17th webinar in the series reflects our ongoing commitment on enhancing professional knowledge and promoting a deeper understanding of complex accounting topics. In today's session, we will explore the practical challenges and common pitfalls relating to inventory valuation under applicable Indian accounting standards and accounting standards. Our discussion will encompass critical aspects such as cost determination methods, that is FIFO, weighted average, etc., the treatment of joint products and byproducts, net realizable value assessment, inventory write-downs and reversals, and the impact of cost formula on financial reporting. We will also examine key disclosure requirements and use illustrative examples to provide clarity on interpretation and real-world application. Additionally, we will highlight how professionals can manage judgment areas and ensure compliance, consistency, and transparency in inventory-related accounting and reporting. Through this interactive session, our aim is to empower you with a deep understanding of inventory valuation practices, thereby supporting more informed and related financial statements. We are excited to make our session more interactive by incorporating live poll questions. We encourage all participants to take part by clicking on the open poll button whenever a question is being posted by our eminent speaker. Your responses will help shape the conversation and make the session more engaging for everyone. We look forward to a rich and engaging discussion. Thank you once again for joining us. We are privileged to extend a very warm welcome to our esteemed speaker for today's session, CA Rajkumar Agarwal sir. Before we go into the technical discussion, it is my pleasure to introduce the moderator for today's webinar, CA Kaleshwar Prasad sir. CA Kaleshwar Prasad sir is a fellow chartered accountant with over 20 plus years of post-qualification experience in financial reporting, audit, taxation, and consultancy. Apart from being a chartered accountant, his additional qualifications include CISA, Certified Information System Auditor, LLB, and Diploma in IFRS from AACCA UK. He serves as a technical reviewer with the Financial Reporting Review Board, FRRB of ICI, contributing to the quality of financial reporting and professional standards. He is also an experienced faculty and speaker with the Institute of Chartered Accountants of India, regularly engaging in training programs and webinars organized by the Accounting Standards Board of the ICI. Over to you, sir.
Thanks, Rahul, and I thank the ASB for giving me this opportunity. Hope we'll have a wonderful discussion time. Let me introduce CA Rajkumar Agarwal sir. So Rajkumar Agarwal sir, most importantly, is a soft-spoken, having more than 30 years of post-qualification experience, specializing mainly in audit and taxation. He is a faculty member with INDAS. He is also a faculty with Corporate Law Service Academy and Ministry of Corporate Affairs. He is a reviewer with FRRB and registered as with the Research Committee of ICAI. He is also a special invitee with the Government Accounting and Public Finance Committee of ICAI. Very known speaker across various forums of ICAI at branch level, even at a national level. Well versed with audit, gap, and personal taxation and will drafting. He is also certified in startup process. Served as a senior partner with BDO earlier, currently heading audit division at ASC Group, Noida. So with this small introduction of our eminent speaker, I'll hand over the thing to Mr. Rajkumar sir. Rajkumar sir, over to you. We are all eager to listen to you, learn, enrich our knowledge with respect to Ind AS 2. Over to you, sir. You are muted.
Thank you, Kaleshwar, for the generous word, and thanks, Rahul, for setting the tone for today's discussion. And of course, ASB has turning things in a way that we can get professionally more equipped, more qualified, more knowledgeable for the various changing scenarios, and various new things that are coming across. These webinars are for more from a discussion perspective, learning, unlearn and relearn is the real point of today's world. So today's our topic for discussion is nuances with regards to the valuation of inventory. So our thought process is first, I'll take you through the basic India's two inventories, and for approximately an hour and a half. And then we'll do is then we'll take up the questions that will take up the specific industry related thought process. We'll also see what are the special things outside the Indias which actually impact the valuation of inventory, the reporting of the inventory, and of course the audit report also. So all these aspects we'll try to cover out, and let's go ahead. So to start with and keep it more engaging, I'll request all the audience and all my fellow chartered accountants to open the poll, and maybe you can poll on the first question. Request you to give your poll on the first question. So the question is, inventory is valued at cost or net realizable value, whichever is lower, right? Net realizable value is just like fair value of the inventory. Is this a statement true, false, or true? Net realizable value is just like fair value of the inventory. Is this a statement false or true? Hope you have voted on this. So let's go to the standard and see how it works, and let us see all the part of it. So coming on to the first, let us understand the general valuation techniques and the general related thoughts with regards to the valuation of inventory. Friends, there are two things. First, let us understand what is an NRV and what is fair value. In India's, there is another standard which is given as 113, which gives us the principles with regards to fair value measurement. This fair value measurement is basically a fair price. The key aspect of this fair price is that it has to be in an orderly transaction between informed market participants in the most advantageous market on the measurement date. That means it is not an entity specific. So anybody can sell in the open market. It is not where I am only selling, there could be hundreds of other people selling. Now, this fair value is 100% different from net realizable value. Though they have the common feature of being the selling price where I would be able to sell. But in NRV, basically it is NRV in ordinary course of business. Say for example, if I am say suppose vegetable producer, and I sell all my products basically in a market, say near Delhi, where say suppose I'm there. So broadly, all my production would be sold near Delhi. I would not go to south for selling mangoes or maybe the vegetable products. So that is the best market for me. But when I go to fair value evaluation, I'll have to evaluate where all I can sell, and whatever is the most advantageous market, there I'll sell. So it is my entity specific market where I sell. So basically, NRV would mean that selling price in ordinary course of business less estimated cost of completion and estimated cost to make the sales. Okay. Now, these positions are basically the most reliable estimate at the time of when we make this particular computation. With regards to the cost of inventory consists of three things: cost of purchase, cost of conversion, and of course, the other cost that would be added to the inventory. So, after understanding the fair value versus NRV concept, let me go ahead. So our learning objective, let me give you a perspective. This is not more of a India's class, but more of a deep dive into an India's to more to learn the nuances. So the basic standard I'll cover in a very quick aspect so that we do not miss on the key discussion that could happen. So let's go on to what are the inventories. When we evaluate what could be the inventories, the first one is the items which are held for sale in ordinary course of business, which could be finished goods, which could be merchandise, which could be traded goods, and which are in process of production, that is WIP, and which is in the form of material supplied for production, which could be a raw material. This all we know, but let us see it from different perspective. Whether an intangible software can be an inventory. The answer is yes. Any company which is producing software and selling those software is an inventory for them. Okay. Similarly, in a real estate company, a land or an apartment, if these companies, real estate companies, sell apartments or land or different type of property or different type of constructed property, basically it becomes their inventory. A very interesting question is with regards to the packing material. So I'll request you if you can give a poll on question number 2. I'll request you to poll on question number 2. Question number 2 says, packing material is a part of inventory cost. The options are yes, always part of inventory cost. The second is no, it depends. And third, never. Packing material is a part of inventory cost. First possible answer is yes, always part of inventory cost. Second, it depends. Third is never. Hope you would have conducted or given your poll on that. A simple question. Friends, in case of packing material, let us be very clear. The material which is necessary to sell the inventory in a particular packaged form, say for example, a bottle in case of a cold drink or a pouch in case of maybe a mouth freshener, could be a basic packing material. But say suppose after when it is packed and done, and if there is another packing material which is given to the customer to carry that particular item of inventory or particular items, then those secondary packaging material are not part of inventory. They are part of selling and distribution cost. Similarly, publicity material, if I am keeping it, they are not part of the inventory. So generally a publicity material is generally expensed off. There is another very important problem with regards to identification of spare part, standby equipment, tools, and consumables. Whether these would be part of inventory or whether it is part of the tangible asset, that is PPE. Friends, I like to clarify to you all these aspects in a very simple way. Number one, let us first see whether these spare part, standby equipment, tools, consumable, etc. will be used for more than one period. That means any economic value would flow over a period of time from all these items, then it may meet the definition of PPE. And if it meets the definition of PP, then it goes to the PP. Otherwise, they are inventorized. As and when they are used, they are expensed off. Let me take a very good example for this to understand. In packaging industry, the pouch that you get, basically a roller is made wherein the roller is inscribed by the design which comes on the pouch. On this roller, the plastic film runs, and accordingly the pouches are produced. Now, once a company gets an order of X amount, it produces the pouch and then it sells it. Now, after a period of time, it also gets gets another order. Then it uses the same roller to again produce the similar pouch and then sell it again. The question is whether a roller in a packaging industry which can be used subsequently and the economic value will flow, whether these would be part of inventory or whether this can be expensed off. Certainly in this case it will be the part of PP because it has to be used over a period of time. The another example is mold and die, particularly in OEM industries. There are huge molds and dies which give shapes to different components of a car or maybe a vehicle. In this particular case, since it is used over a period of time, therefore it is the individual item may be insignificant, but all molds and dies can be put together and then they can be carried as a part of PP. Another question comes of standby equipment. Now, standby equipment is, say, suppose you have one particular machine to service a particular industry. Now, a standby machine is kept in case if there is an emergency, it can happen. So it can be used. Say, for example, two engines in an aircraft. The second engine is also a part of the PP. But what are the part of inventory? The example could be loose tools. All those loose tools would be a part of inventory. Maintenance supplies and consumable are also generally expensed off as and when consumed and are part of inventory. I hope this should clarify a lot of doubts, particularly with regards to spare part, standby equipment, tools, and consumables. Quickly, the measurement of inventory has to be cost or at NRV, whichever is lower. Cost will include the cost of purchase, cost of conversion, and other costs for bringing the inventory to present location and condition. So the important part is about whether what cost is to be incurred directly attributable to bringing the inventory to present location and condition. NRV, as we already discussed, it is estimated selling price in ordinary course of business minus estimated cost of completion and minus estimated cost of sales. Now, let us look at these items individually. Particularly, now I am dealing with these items in detail. Now, in this case, the cost of purchase would include purchase price, fundamental, import duties, non-refundable taxes. Now, GST is a non-refundable taxes or refundable taxes. Refundable because you get the credit of it. So you get it refundable. We'll also try to cover certain things around GST, particularly when we'll discuss about the tax audit implication. Transport and handling charges. Any inventory which is coming to you and there is a transport charge, this has to be added to the cost of inventory. Other costs directly attributable to acquisition of finished costs. The two items particularly are of interest: trade discounts and volume discounts. Trade discounts and rebate, they are netted off. But cash discount at some times become parts of other income. But normally those are cash discounts are when you pay upfront at 2% or 1% when you get a deduction over a period of time, they might be not a part of inventory, but trade discounts and rebates are volume discounts. Volume discounts, basically, the problem with volume discount is one. The scheme for volume discount is for a particular period of time, that if you take or uplift or lift X amount of quantity in one particular year, in that case, what would happen is you'll get X amount of discount. If you take Y quantity, the discount would be higher. And in case of Z quantity, the discount would be even higher. Like, say, for example, in day-to-day purchases, now Diwali is already there. So what we see is that if you purchase one item, the discount is 10%. If you purchase two items, it is 20%. It is exactly a volume discount. Okay, friends. Now, the principle that we have to apply is when it becomes probable that you will get the discount, then, and it can be reliably estimated on an ongoing basis, then you can take the impact of volume discount. Let us we'll take an example on this, and then probably it would be more clarified. Just wait for a minute, we'll come to it. Now, cost of conversion, that means in a manufacturing company, the raw material is converted to finished goods. So every cost, whether it is material, labor, or other direct costs, it is to be added to the finished goods. Now, basically, it implies that I have to systematically allocate the variable overhead and systematically allocate fixed overhead. Now, this allocation is a very difficult and sometimes very less understood part, how to allocate. So, friends, let me tell you, at the end of the year, when you are calculating the value of finished goods, what you do is you identify all the cost. What are the variable production what are the variable overheads that are there in total? What is your actual production and what is the inventory left out of it? So the total variable overhead would be for all the items which you have purchased and sold, which you have produced and sold, and what is left over. So all you have to do is you have to find the allocation for the leftover, including all the other items where my production overhead would go. The key important part in production overhead, it is based on volume of production. Here, volume of production, I would mean as actual cost, actual production. Okay. Whereas in the case of fixed overhead, what I do is, since overhead are also fixed, there is a probability that it may be under-absorbed or over-absorbed. So therefore, what I do is, in case of fixed overhead, I take the normal capacity. Take the normal capacity. Now, as the normal capacity are there, what we do is we divide the actual overhead by the normal capacity and take out per unit cost, and then whatever the inventory units are left over, multiply by that will give you an absorption of the fixed overhead. I'm not going into the detail of what fixed overhead would be. I know my friends would know it very nicely. So let me go ahead over the important part. As I told you, the fixed overhead are based on normal capacity and variable overhead would be based on the actual capacity or actual production. Now, when I'm allocating or absorbing fixed overhead, I mean to say by absorption, when I'm valuing my closing stock, I have to allocate the fixed overhead over those items. So I absorb them. So the calculation is based, and then I load my inventory with these fixed overheads. Now, what is normal capacity? Normal capacity is when you normally what you are required or you would be able to produce. This would include the normal wastage of time, the normal period when you do the plan and maintenance, etc. This all goes into it. But if there is idle capacity or where there is overproduction, we do not take it into account. Why? Otherwise, the fixed overhead would be overcharged or overabsorbed. Let us take an example. Say, for example, assuming that the normal operating condition, a white good manufacturing company W expect 100 heaters a year per machine line. So normally I'm able to produce 100 heaters. Budgeted and actual fixed production overhead for the year is 800. At what rate the fixed overhead should be absorbed? So normal production is 100 heaters. The fixed overhead is 800. So 800 divided by 100 gives 8 rupees per unit. So whatever your leftover inventory is, the amount of inventory you have to add this fixed overhead as an absorption. Now, in case if there is a lower demand and only 80 heaters have been produced, in that case, what I should do? My normal production is 100, but my present production is 80. Now, if in this case, I would have to still do it as per 8 rupees per unit because this is based on the normal production. So my absorption would be only 640, and the balance of 160, that is on the 20 units which I am not able to produce, it goes to the profit and loss account. So I do not over absorb or under absorb. The case 3 would make it very clear. If say suppose my production is 130 heater, then what change would be there? In this case, what we do is you have to absorb 800 rupees. The per unit would be 6.5 because 800 divided by 130. In this case, what we have to understand is that I should be able to absorb all the 800 rupees as a fixed overhead. So friends, I think this absorption should make it clear, particularly with regards to the fixed overhead. In audit, we find a lot of anomalies in this. One of my assistant and many of my clients comes to me and asks me, or rather they do whatever they want, and then when the audit is there, all the correction happens. So what I normally do is educating the client is one of the very key aspect. We might not expect a SME accountant or SME promoter or entrepreneur to know how the absorptions takes place. But before the audit, during the year, if you are able to tell them how the absorption would happen, I think as an auditor, our life would be really very easy. Nonetheless, let us go to the other cost. Now, this could be interesting. Transfer cost from factory to warehouse. Basically, all the transfer cost up to the production time until making available for sale. Basically, it becomes the cost of the inventory. So that cost has to be included. Cost of designing a specific product. That is also the part of inventory. Borrowing cost is important. Now, let us understand, normally, as per Ind AS 23 or capitalization method, it is related that if your project is a very long project and you have incurred the interest cost or borrowing cost on it, the amount can be capitalized to PP. That is what we have learned. But at that, in Ind AS 23, the reference for inventory is not there. The reference for inventory is in Ind AS 2. Ind AS 2 clearly tells that if there is a borrowing cost related to items which are manufactured in large quantity and routinely, then the borrowing cost cannot be capitalized. Now, what does it mean? Say, suppose in a normal manufacturing company where the production is happening from day to day and there are different items produced, you cannot add the borrowing cost to the inventory. It has go to the P&L. But if you observe it from a real estate company, in that particular case, it is not the small items that are going to be produced every now and then. It is a longer project. So probably there you could actually add the borrowing cost to the inventory because a lot of money is taken as a debt in case of real estate company. One of the other item which is very peculiar to India's and which was not there in AS or which is not there in AS is the deferred settlement terms. Any inventory which is purchased on deferred settlement term and the cost of the inventory becomes higher because you would be paying over a deferred period. So there is an interest cost involved in it. So India's 2 clearly states that in this case, you have to find what is the normal purchase price and the difference between the normal purchase price and the enhanced purchase price. That difference is not cost of inventory, but basically it is it is a finance cost. So in case of deferred settlement term purchase of inventory, we would have to segregate the normal purchase price of the inventory and the finance cost. Cost goes to finance cost, inventory cost goes to inventory cost. The other important thing is the administrative overhead. It is not to be added. Selling cost is not to be added. Distribution cost is not to be added. Abnormal amount of wastage labor is not to be added. We cannot account for the wasted labor. It is a loss. So we have to take it into account. The storage cost, until this is related or required for necessary for production process or before further production process. If we have reached the last point, of the production process and made it ready to sell, till that storage cost is required to be a part of inventory. After that, it is a distribution cost. Let us take a small example. Chroma places an order of 100 fridge from Samsung at a price of 10,000 each. A volume discount of 10% is given if 100 fridge are purchased in a year. Okay. Chroma normally buys 100 fridge during a year. Normally, it uplifts 100 fridge. Chroma initially in a one particular year is not sure that it will purchase 100 fridge because of the cost or maybe market condition. But after 6 months, the management expect that they will be able to uplift or lift 100 fridges. At this point of time, 50 fridges were sold and 30 were in hand and the balance are yet to be lifted. How will the cost of inventory would be done? So out of 100 fridge, I had purchased 80 till 80 items when I became sure that I'll be able to take another 20 items. At this point of time, my 50 items were already sold and my 30 is in hand. Now the question is, this 10% discount, how it should be accounted for? So friends, as I told you earlier, in this particular case, the first thing is, when do we account for the discount? When do we account for the discount? So in this case, the 10% discount is to be accounted when I am reasonably sure. Okay. The point of time when I'm reasonably sure is this point of time. So I would account the 10% discount at this point of time. Fine. Now the problem is, out of this 50 is already sold. So any discount related to this 50 will go to the profit and loss account. Discount of 30% will go to the inventory, and the balance of 10%, as and when the purchases are made, the inventory would be accounted at the discounted price. So this is the solution for this. So rebate of should be credited to PL. Subsequent 20 item discount should be accounted for the cost less 10%. If you have any question, maybe you may note down. We'll have a question and answer session where we'll discuss the same. Another interesting aspect is joint product and byproducts. The standard is very clear, but before that, the most best example is petroleum and diesel lubricant, etc. Now, the standard clearly says that now what is happening is there is a stage of refinement. At a particular stage, you get petrol and diesel, which is further processed. Now the question is, up to this particular stage, all the production costs are joint, and after that they are separated. My problem is how to identify or how to distinguish this particular cost or how to differentiate these particular costs. So these standards say that it has to be done on some rational and consistent basis. So what could be the rational and consistent basis? Whether it should be the cost of raw material or whether you standardize certain thing. So the way it is given is that you find out the relative sale price at the point of separation. The point of separation, you find the relative sales price. Now, why relative sale prices? Because it will be produced in different quantity. You just can't apply the ratio. So it will be produced in different quantity. So the relative sale price total multiplied by the quantity will give you the relative production. And basis those ratio, you can actually allocate the cost to the two joint products. As far as the byproducts are considered, it is considered as incidental product. Their market value may be very low or it could be a scrap. So actually it is measured our NRV and the value is not deducted from the main product. Byproduct is material, then treated as a joint product. If there is a byproduct which is very material, then it is just like a joint product. And the sales price from scrap, if it is material, it will go to other operational income. As I told you, how to separate the item of the joint product. So say suppose there is 1000 unit of X that is produced, 2000 unit of Y that is produced, and their selling price is 60 and 20. So their total selling price is, say suppose 1 lakh. So by calculation it comes to 1 lakh. What I have to do is I have to allocate cost. And in this example, the cost is 80,000. So what I do is this 80,000 is to be divided into their comparative selling price or sales value. Okay, so their comparative sales value would be this 80,000 is divided into 1000 multiplied by 60 divided by 1 lakh, their total sale price, which comes to 48, and this comes to 32. Total 80,000 is absorbed. So what I mean to say here is, it should not be in the quantity, otherwise it would have been 1 and 2. Their sales price are also different. So therefore we have to find the total sellable value, and this will give us the absorption. Now friends, let me come to the cost formula. The way to understand the cost formula is the standard maintains or guides two type of inventory item. Inventory item which are interchangeable or inventory item that are not interchangeable. Say suppose for a particular production, you have to put into a machine a particular important component which is purchased for that particular machine. Or say, for example, if you are a real estate company, you take a particular type of marble for high rated units. Now, this particular marble is a specific for those particular unit or that particular unit or for that particular machine. In this case, the standard says you have to use the specific identification method. This is generally applicable in jewelry industry also. Say for example, if you are purchasing 10 diamonds to be put in 10 particular rings, then the cost of the ring at the time of finished goods has to be valued together with the specific cost. It cannot be a weighted average or FIFO method. It has to be the specific cost. Now, in a general business, other than maybe a jewelry or maybe a specialized machine, normally a inventory item is interchangeable. Now, when I say a item is interchangeable, say suppose you are producing, say suppose a OEM is producing a assembly component of say a meter in the car. Now, in that meter, there are 20 type of components. Now, those components are lying here and you can use any one of the component. They are interchangeable. Okay. It could be a different example also, but basically it means the same. Now, the interchangeable item gives a position which is based on the inventory valuation can be based on either a non-historical cost method or a historical cost method. When I say FIFO or when I say weighted average, which are the most important two cost method or cost formula as we say, in this particular case, they are called historical cost method. Reason being, FIFO means I have incurred an inventory cost that goes into my account, right? That particular cost basically is the cost where I have in my books of account. Once it is sold, so my first in, first out, that particular inventory item goes out. So it means that it is a historical cost. I have done nothing in that. It is basically the cost that is available in my books of account. But the calculation can be done either by FIFO or weighted average. Friends, in case of non-historical method, many industry, they follow this particular method, which is called the standard cost method. Now, what happens is, it is very difficult to find weighted average at every iteration, or it may be also very difficult to find FIFO basis and allocate cost to each and every item. So what companies do or what entities do is they find out the standard cost of the inventory based on their production and they calculate the standard cost. Whatever the cost is coming, that goes to the profit and loss account debit, and accordingly the cost is accumulated. Now, when I'm issuing to the shop floor or whenever I am working on my inventory allocation, I do it at the standard cost. In the end, what happens is there is some amount of inventory which is left. Now that has to be valued. You can also value that particular inventory at standard cost. But the standard says that this standard cost should be near to the actual and it should be really revisited from time to time to see if there is any changes in standard cost. Normally what happens is, even in the standard cost, a yearly iteration is taken at the end of the year where any difference between the standard cost of the inventory and for the whole year put together based on the quantity is then accordingly adjusted in the books of account. So my inventory remains at actual cost at the year end. Next year, again, the standard allocation process comes into play. There is another interesting method in case of retail. What happens is, in case of retail industry, just imagine Reliance Retail or maybe DMart. Now they have 1 lakh, 2 lakh SKUs, different item, different size, different prices, different colors and everything. Now how to find the closing inventory in such case? In the case of valuation, what happens is, even if I keep the amount or the quantity of the inventory that is tracked, but what happens to the value? How do I allocate a small transportation cost? How do I allocate the what do you call the uh, uh, a fixed overhead or variable overhead? So the standard prescribes that where there are similar type of item, then in the case of retail, what you can do is you can work out on the gross profit method. So what I'll do is I'll define the retail into the different gross profit category. Say for example, my ladies garment, they carry different profit. So let us keep it at 30%. They calculate it and keep it at 30%. Now man's apparel, they may be at 25%. Or there could be fashion jewelry, which may be at 40%. There could be day-to-day toiletries. Now that could be at 8%. So what I do is I have the quantity, I divide it into different categories and gross them down so that I'm able to see what is my cost based on the sale price. If it was 8% on sale price, then what would be my cost? Basis that you can calculate by way of a retail method the total cost of inventory in a retail industry. Now, the biggest thought process, probably whatever we have discussed, you would have seen from time to time in different ways over a period of time. But the NRV testing, this is one of the most important aspect to understand and relearn. So let us first see what is NRV, which we already saw. It is estimated selling price in ordinary course of business. In this, we reduce two things: estimated cost of completion and estimated cost of sale. Not to consider the cash discount for early payment. We don't have to consider the cash discount. It is based on the most reliable evidence at the time of estimate. So NRV testing you will not be doing on 31st March. It would be sometime later when you are actually calculating or closing your books of account. Okay. Now, what is the basic principle? Why do we do this NRV testing? So friends, let me tell you, all the Indies or any of the standard works on one very basic fundamental rule. This fundamental rule is, in my balance sheet, there are different assets. They are being given a one value. None of the asset should be at a value which cannot be recovered. That means, if I say it other way, my asset in my balance sheet has to be at recoverable value. Irrespective of whatever the cost you have incurred for the inventory, you should be able to recover that, isn't it? Now, how I would be able to recover that is by way of realizing, by way of sale. So what I see is how much I'll be able to realize by sale. Say suppose X amount, but there could be a possibility that there are further expenses for making that sale. So these two particular items which are required for making the sale, they are reduced from these two items which are required to make the sale. They are reduced from the selling price, and that gives me that this is the amount that I will be able to recover. And balance sheet should not have the number which I cannot recover. So the NRV testing brings down the value of inventory to its realizable or maybe at a recoverable level, so that my basic principle of realizability of asset, value of the realizability of asset, is adhered. Now, normally inventory write down may also happen in case of damages. So if say suppose there is a large depot and the inventory has been damaged. So whenever the inventory is damaged, the cost has to be brought down. So it is also a part of brought down. If the inventory becomes obsolete after COVID, we all know that how fast the world is changing, how fast the fashion is changing. I think I remember reading one of the case study of Zara. In case of Zara, every month the entire merchandise or every garment in a particular store is changed. If you go at one particular time and after 1 month you go to a Zara showroom, everything is changed. I also studied that in case of Zudio, one of the Tata enterprise, they are following the same principle. In that particular case also, in that particular case also, in uh, they change the inventory after maybe a particular period of time. Now, when you are changing this inventory from time to time, broadly it is obsolete, or maybe it will not realize the value that you would have expected. So whenever we are wholly or partially writing down the obsolete, basically it is a type of NRV testing. Decline in sale price. So if there is a decline in sale price, so what I mean to say is decline in sale price means your profit has been taken out. If your profit has been taken out, that means that your cost of inventory might not be realizable. So sale price reduction is an indication. Similarly, like if the goods are damaged or goods are obsolete. The other way to look at around when we have to be specific about NRV testing is when the expected cost of completion becomes too high. Okay. Now, if the expected cost of completion is becoming too high, that means your profit would be squeezed or there might be also a loss. So therefore, we attempt to do the NRV testing and accordingly we bring down or write down our inventory. Uh, Now, what is the process? How do we have to do it? Whether we have to do it at a global basis or we have to do at another basis. So the standard is very clear. It has to be done on item to item basis. If there are hundreds of apparels in Zara showroom, every apparel would have a different history and different reasons and different ways for its cost calculation. So you have to bring the inventory item to item, and of course, similar item or related item can be grouped. Say, for example, different colors of a sweater or one particular range of a sweater. That is particularly the item that can be grouped. Now, write down is not appropriate for particular class of fair finished goods or raw material. Now, it basically in this particular case, you just can't do that. I would only take a particular write down or NRV testing of only a particular item or particular type of item. NRV testing has to be done on item to item basis on a similar group, and accordingly, it has to be worked out. Now, with regards to how to estimate, yes, reliable evidence at the time of estimate. Even in the India's events after occurring after the balance sheet date, So any event occurring after the balance sheet date which impact your sale price or the cost of the completion is taken into account as on 31st March, and it is considered as an adjusting event. Okay. There is another point here. There is another point. It says that the NRV testing for a contracted price. Now, say suppose let us take an example of OEM only. In case of car, now the sub manufacturers or the OEM supplier, they have a contract for 3 months or 6 months or maybe for 1 month. So whatever the contractual price is, basically that would be the price on which the NRV has to be tested. Suppose in case of the pricing goes down, but that contracted price would remain the same. So therefore, in such cases, the contracted price becomes the base for doing the NRV testing. There is a particular question with regards to the raw material. Should the raw material be also tested for NRV testing? The answer is yes and partly no. I would put it like this. Now, basically, if there are indication like the raw material price has gone down to such an extent that it will impact the selling price, then of course the NRV testing has to be done. The replacement cost of a raw material is also an indicator for such item. Basically, raw material, since it goes to the finished goods, and a small variation in raw material may not be an indicator for an NRV testing, but certainly raw material plays an important role in overall costing. So it will depend upon the fact how the NRV testing of the raw material has to be done. Basically, if the policy generally is the raw material which goes into the finished goods, if the finished goods prices get lower, then the NRV testing of raw material is done. The NRV testing is always reviewed from time to time. Say, for example, you have reviewed your inventory and you have done your NRV. Now you have brought down the inventory. Next year, for some part of the year, the particular price at which you told that this is the NRV, you have a same price, so you don't make a profit. But in another quarter, the sales price have better, the conditions are better. Now you sell that particular inventory. In that case, the profit automatically goes to your profit and loss account in the period in which you do the sale. Now let us consider the item in which you made a write down of basis the NRV, and that particular item remains unsold. The question is whether at the end of the second year, whether such particular item or those items, can they be retested for NRV if the NRV goes above? So the answer is yes. If at a subsequent date, at a subsequent reporting date, if there are changes in NRV, you can reverse those NRV by which you have written down of the inventory which is lying in your hand. But yes, subjected to the case that the reversal should not be more than the write down that you actually did. So you can't make profit with yourself. Okay, so we have to take that care. I can tell you, in case of when the COVID was there were a lot of companies which did the NRV testing, did the write down, but in the next year, I remember some companies where the write down happened on a positive manner. A similar example is for Tata Motors. Not specifically for NRV, it is for impairment. In case of impairment, it is Ind AS 36. Now, if the recoverable value of your asset goes down, then you have to impair those assets. Since cars were not produced, so due to impairment testing, in the COVID year, Tata Motors, which is a public information now, brought down its value of the non-current asset something like 1400 crores. But later on, even India's 36 says that once impaired does not mean every time impaired. Then they retested for impairment when the indicators were positive. When the indicators were positive, their car began to sell. So it came to the front by calculation that yes, the recoverable value of the non-current asset would be higher. So they reversed the impairment. So NRV can also be reversed. Similarly, impairment can also be reversed. I'll very briefly touch upon the biological asset, and which is a very interesting index with regards to index 41. I'm talking about. In AS, there is no standard with regards to the biological asset, that is agriculture, but in India it is. So I'll briefly give you the point which is related to inventory. Now, say suppose what is biological asset? It is animal and plants. So I bring 10 cows today, I feed them for a year, then the next year, and in the third year they become capable so that I can get the milk. Now, in the first 1 year and second year, whatever the cost you have incurred, how do we account for? So the cost is normally accounted for. But at the end of every year, India's 41 says, para 12, that at end of every year, you value the plant and the animal at fair value less cost to sales. So in the second year, first year I brought at the end of first year, and at the end of second year, and at the end of third year, what I'll do is I'll revalue my animal. A calf would be, say, suppose 10,000, but a grown up calf would be 15,000. So this 5,000 becomes my part of the value changes. So that is how the biological asset, that is animal and plants, are valued. Now, coming on, why I'm telling this is in the next paragraph. Say, suppose you have sown seeds and there is a weed, and on 31st March, there is before 31st March or at 31st March, there is a weed grown. Now, at a particular point of time, you'll harvest that crop. Harvesting means you detach that particular crop from that particular harvest. You'll harvest the seed from the crop which you have grown, right? India's 41 says that at the point of harvest, the wheat or the flour which you have detached or harvested, the value in the books is to be recognized at fair value less cost to sales. The background of telling you is this. Say, suppose I am a mango grower and I am a juice producer. At the point of harvest, my mango would be valued at fair value less cost to sales. Basically, this becomes the cost of inventory of mango for my juice production. If I have a contracted price for sale of mango, that contracted price becomes NRV. So I have to put it at the NRV. That is what it could be sold. Okay. So that was a very brief about biological asset and agriculture produce. So anybody who's producing biological or maybe agriculture produce, the cost of the inventory is governed by India's 41. Once it becomes inventory, the cost at the starting point is fair value less cost to sell. And thereafter, if you maintain it as inventory, it becomes your inventory cost, input inventory cost. That is where I'm coming from. In case of commodity broker, where the buying and selling of the securities is done for getting the market price fluctuation, profit from market price fluctuation. In all this case, the objective is certainly to get the differential as profit. wherever this is the situation, the measurement is at fair value less cost to sell. That is what you call it as an M2M, that is mark to market. So therefore, in case of commodity broker, this would be a fair value less cost to sell or mark to market thing that we have to do. Now, the way the standard is designed, how to recognize the expenses of inventory. So by this, what we mean is simply that whatever the difference in inventory closing and opening, when it will go to the profit and loss account, that is the indication. So it doesn't affect our basic principle and the process by which we make a profit and loss account. So the principle is inventory is to be expensed off in the year in which the revenue related to year is recognized. So you'll have to put the cost of the inventory, or the COJ should take only the part of that cost which has actually been sold. In nutshell, this is what it means. Write down and write up, that is the NRV testing. It is also in the period in which either this loss has happened or the update has occurred. Reversal. Now, when I reverse the inventory or when I reverse the write down, that means I'm creating some profit. The question is the difference whether it will go in enhancing the value of inventory or it becomes your other income. Certainly, a reversal of write down is a reduction of inventory cost. So it doesn't go as your other income. It may sometimes be possible, or it may happen that you are constructing a particular asset in which you are also using your inventory. So the inventory is allocated at cost to the CWIP, and this CWIP gets amortized, or this CWIP gets capitalized at a point of time. And the inventory cost, which is included in the PP cost, get amortized over a period of time. So it is a simple way of telling things that if any inventory item is used in the preparation or it goes to the PP, so it is added to the cost of PP. Now, disclosure. Normally, what I found, disclosure with regards to inventory is reasonable in all balance sheet, as my experience as a reviewer. But broadly, what I found the basic deficiency is the cost formula. So just pay attention that the cost formula is disclosed. So the FIFO method or the weighted average method, whatever you are using, or a specific identification method, that particular cost formula has to be disclosed in the policy together with the policy. And the policy would be that what are the type of inventory you have, what are the class of inventory you have, what goes into the cost, what doesn't go to the cost, and what cost formula you use. That is to be disclosed in the inventory. The other item which is required is the carrying amount of inventory. Of course, the carrying amount of inventory is there in the balance sheet, so you don't need to worry about it. The other thing is classification. In classification, what happens is you have to do it as raw material, work in progress, finished goods, and the changes is to be given. One important thing with regards to classification is GIT. Now, GIT has to be added in the respective item. Say, suppose my GIT is raw material, then the raw material portion is has to be added with the GIT, and you have to disclose it. What is that you have and what is the GIT you have? It may be either by way of a note or it could be by way of a sub-classification. If say suppose you are taking or purchasing trading goods, or even if you are purchasing some finished goods, and if there is a GIT in it, it has to be separately disclosed. Okay. Then any amount of inventory where you have valued at fair value less cost to sales. So any company in agriculture field will give what is his basic inventory and what is the amount which is being valued at fair value less cost to sell. Amount of inventory recognized as expense. This connotes the item that is changes in inventory. So that is the amount of expenses that is recognized, and it is separately also disclosed. If there is a write down, we have to disclose it. If the inventory is placed for bank to bank, then again the security that is given is what do you call it, disclosed, that what is the amount. If the inventory is pledged or hypothecated to the bank, then the fact is disclosed. And if there is a reversal of write down, of course that disclosure need to be there. On your screen is the inventory policy, which I've taken it from Asian Paint, which is a public information. Certainly, you can read the Asian Paint. I'll not invest much time in it, and you can refer this. Similarly, how the inventory should be disclosed: raw material, this much amount, and raw material in transit is separately disclosed. Packing material, work in progress, finished goods, and finished goods in transit. The stock in trade in transit. The stores spare, etc. Okay. And similarly, the other disclosure are there in the background. Now, let us come to the gap differences between Ind AS 2 and AS 2. Broadly, the cost formula is same. Okay. And broadly, the fundamental principles are also the same. Broadly, the fundamentals and the principles are same. Let us see the difference. For reversal of write down, Ind AS 2 give detailed guidance. Ind AS 2 does not have such type of detailed guidance. Inventory acquired on deferred payment system. The finance element has to be separated. There is no such requirement in AS2. The guidance is not given. No specific guidance is given for item covered under Ind AS 16, that is PP. AS2 is specified that spare part servicing equipment and standby equipment which meets definition of PP are dealt by Ind AS 10. Whereas Ind AS 16 gives a line that spare part servicing equipment and standby equipment which meets the definition of Ind AS 16, that is the PP, would be PP, otherwise it will not. So either way it is the same, but it is a difference of the location. But yes, the ultimate answer is the same in both the cases. Agriculture produce, it gives some guidance, that is the input of fair market less cost to sales would be your inventory input cost or the starting cost. AS2 does not refer to the agriculture part. Cost formula, it says that application of same cost formula for all inventories that have similar nature and use. It is not expressly given, but it is broadly covered. These are the major difference. So if I see broadly, there is no difference between Ind AS 2 and AS2 except some enhanced guidance with regards to the finance element and reversal of write down. So that is all from my basic discussion, and maybe I'll request all the participants to maybe attempt, maybe first, maybe Kaleshwar, over to you now. We can the other polling maybe as if we have time.
Sure, I think we still have a good time for clarifying the questions. First of all, thanks for the detailed explanation what you gave, item by item things. Okay, so now is the time for question and answers. So as and when we get a question and answer from the participants, I'll pose it for you. So Rahul, as and when we come across new question, you can just help me with those questions. So one question what we have got is in industries which are facing a price volatility, how should NRV be estimated reliably at the period end?
Yeah, very nice question, especially in the case when even silver is jumping 5,000 rupees a day. Actually, nobody knows the real price of silver today. Yes, volatility is a very important aspect, and with information technology, this has ever increased. So, what I suggest from my experience, so nothing is specifically is given; it is a matter of judgment. But what I suggest is uh, just near about to the balance sheet date broadly, whatever the facts and circumstances should be documented. Certain assumptions and estimates have to be done. And if you are following India's, then assumption and estimates have to be disclosed. So, basis on those disclosure and whatever the assumption you have taken, you can have a cutoff date and a particular date, and whatever are the facts on that particular date, that should be taken. We should not be impacted by that volatility. Important thing is it has to be done rationally. You cannot cherry pick that what date is suitable for me between 1st April to maybe May if you are doing it. So between 1st May to 25th May, I'll take a day which is the silver price is the best. No, we can't do that. We have to be rational.
Very good. I think you have given a very interesting aspect. One is estimate. NRV is basically the estimate of a price. The second thing is, yes, rationality. So I think the management discretion will be more appropriate in this case whenever there is a volatility, a price fluctuation. Management need to draw a line and they need to go for a realistic estimate to arrive at a net realizable value. Well said. This was actually a question which I wanted to ask. The second question is basically, could you bring down the difference between NRV and fair value in one line? And is the distinction actually required? So again, a question from a participant, which I've just posed it for you.
Yes. So I think I started my discussion with fair value and NRV. Now, broadly, India's, okay, you asked in one line. Fair value and NRV is not similar. NRV is what you estimate the way in. So let me rephrase my answer. If you want to sell it today and to the best aspect, what you are able to sell in the best way in your market, which you have been normally doing, that will be the NRV. If you go to a expert and tell him to find the value, fair value, that would be a fair, a practical answer.
And another way of putting it is like fair value is, as you rightly mentioned in the initial discussion, is a market specific. Whereas net realizable value is an entity specific, which you had covered it earlier. So I think that could be a one-line differentiator.
Yes.
The question further is, why is it important to distinguish the two in valuation? Why is it necessary for us to distinguish when it comes to valuation?
So technically, the India's 2 or AS2 points at only NRV, not at fair value. Number one. Fair value calculation is a very technical calculation. You have to apply the entire standard India's 13. So in an ongoing thing where you are selling and purchasing inventory every day, the fair valuation is not required. Your entity specific is required.
Yes, and even the standard makes it very clear how you are expected to ascertain the value of inventory. So I think we need to go with the requirement of the standard. The next question from the participants: when inventories are written down due to obsolescence, what are the disclosure and reversal requirement if values recovers later? So let me put the question again. In case of obsolete items, what are the disclosure required? Second part of the question is, previously you recognized a loss in relation to inventory. Subsequently, if there is a reversal of a loss, what are the disclosures required?
So it is very simple. I have I have covered that in my disclosure thing. So, in case of write down, basically inventory testing connotes to write down. So, if you have written down, the amount is to be disclosed. And in case of reversal, again, the amount is to be disclosed and probably supplemented by the reason.
Yes. The reason as to what is the basis for you.
Basis. What is the indicator or basis?
Yes, sir. So we have a next question, which basically only a part of a question I'll read out. So that how do you account for excise duty or other manufacturing taxes under Ind AS2 while valuing a stock?
See, very simple. We have to be very clear in this particular thought. We have to distinguish excise duty with GST. Friends, this question is very specific, but let me elaborate a bit together with the GST. We have to very clearly understand that GST is, we are just like recovering GST on behalf of the government or the regulator. So GST is neither our cost, neither our income. So it is not accounted for as in any part in the profit and loss account, except as whatever, if you cannot get the credit and that is a cost for you, that goes as a cost. As far as the excise is considered, the excise is considered as the part of cost. So it will be added, subtracted, everything, and even the revenue is given, including excise, and the excise is disclosed. So it is the part of all P&L items. Maybe you'd like to add something, Kanish.
Thank you, sir. In fact, let me repose the question in a different manner, which I wanted to ask you. Basically, taxes could be categorized into two, just for in a layman terminology. One is pass-through taxes. Pass-through taxes, simple example is our GST, wherein we act as a medium. We collect taxes and pay it to the government. The other taxes which we do not get a benefit, basically excise, customs, or those kind of a thing, when we do not get a benefit of that, so those will very much form part of the cost. Pass-through taxes will not form part of our cost.
Exactly.
Yes, that was very well explained in the initial presentation also. To make it more, we'll go one step deep into this. I would like to draw your attention to section 145A of the Income Tax Act, which says that, which talks about the valuation of stock from the income tax perspective. Under the income tax perspective, section 145A, read with even our income computation and disclosure standards, which are almost similar to section 145A, it says that inventory have to be valued following inclusive method. When we say inclusive method, it doesn't differentiate between this pass-through taxes like GST nor the custom or excise. It says every tax will very much form part of my inventory valuation. However, in a general parallels, we will be following something called as an exclusive method. So especially if you're talking GST perspective, we'll be following an exclusive method that GST will not form part of my purchases, nor it will form part of my sales. So my question to you is like, when section 145A, which is a requirement of the law, clearly says that you are expected to follow an inclusive method of stock valuation, but in reality, most of us, even in my practice, most of us, we follow exclusive method. Are we not violating the requirement of the law? Is my first question. And even in tax audit, so there is a clause wherein, clause 14B, which clearly says that if there is any deviation in the method of valuation being prescribed under section 145A, you need to give a reason. So are we actually, so my second question is, how do we report that in clause 14B of my tax audit report?
Oh, yes, this is a very, I think tax audits are going on, and this question would be there in mind of many of us. Let us clearly distinguish what is required and what we are supposed to do. So let us put in place first the accounting standard. The accounting standard Indias 2 or AS2 says that whatever the taxes which can be recovered will not form part of the inventory or profit and loss account that is passed through. So accounting standard is very clear that those items will not be part of the profit and loss account. It is on a balance sheet item, not a profit and loss item. Now, Companies Act Section 129 says all the accounts have to be made as per the accounting standard. So we, as a company, I am complying with 129 section and then accordingly complying with this accounting standard. So my accounting is right. So friends, when you are accounting exclusively for GST by way of exclusive method for GST, I'm doing nothing wrong. Number one. Number two, now comes another act. The Income Tax Act, let us specifically point out, there is section 145A. The subsection 145A subsection 2 says that valuation of purchase and sales and goods shall be adjusted to include any of the taxes which is paid. So broadly, the income tax requires that we do a particular inclusion method. That means when I book on my purchase, I include GST. When I make a sales, it has to be included with GST. Now, broadly, I have already made my books for this. To bridge this gap, there was ICDS that were included. That when you do the computation and when you do the disclosure and computation, you have to follow this. Now, basically, I have to just fill my return of income. Now, where do I do this calculation? So you have to practically, the aspect is that you do it and keep it in your records, just as that my inclusion method, what would be the changes. I'll come to it. Then there is wherever there is a tax audit, so we get a clarification on that particular part. So the tax audit, particularly which you mentioned, clause 14b, tells what is the impact of 145A. So broadly, the taxman is requiring us just to see if there is an impact due to inclusion or exclusion that should be added to the profit and loss account. So if where the tax audit is not there, if there is any impact, we add it to it, add in the computation. So my work is done. In case of tax audit, there is a disclosure also. Now there is a practical problem. When I am reporting under 145A, the table requires me to give the particular, and because of this inclusion, if there is any increase in profit, or because of this inclusion, there is any decrease in profit. Okay. Now, it is a question which has been asked particularly from my own circle, maybe a couple of times in the last 1 week. So friends, what you have to do is you make a what you call trading account, by which we used to do in older time. You make a trading account, opening stock, purchases, gross profit, sales, closing stock. Make another column which would be GST. Make other column inclusive of GST. Add GST to it and you get the total column. So broadly, whatever the purchase you have, the GST on the purchase you can get directly from the GST return that is to be added. Whatever the opening inventory is there would be, you can calculate whether it is 18%, 12%, 5%, you add that GST. In sale, you would have raised the invoice and GST figure would be there. You put that GST figure. In closing stock, the GST would be there. The GST figure would be there. Now the problem arises that we have to understand that there is another item which is called ITC, which will be there for all the other expenses which has gone to the other part of the profit and loss account and which is available to me for payment of my output GST, right? So ideally, to balance it, this ITC has to be in this trading account in the amount that this is what I have to pay as an expense, which has been paid out of my other items. Broadly, it would be reconciled, but there would be a smaller item which would be, say for example, the sales return, credit note. So if you plus minus it, broadly your total gross profit inclusion and exclusion would be the same. The fundamental principle, friends, you have to understand it, that are you earning GST or you are only passing through? If you are not earning, so there would not be any impact of the profit. The only problem is this reconciliation. Yes, there are problems in this reconciliation, but broadly, if you include all the items with regards to the other GST item, probably there would not be any impact with GST or without GST. So it is more of a disclosure rather than other part. One hint I like to give you, that in the questionnaire, in the utility, there are two parts of the questionnaire. Is there any impact? If you say no, then you don't have to give the detail. So we are then out of it. Yes, there would be some challenges, but except the case where people are earning from GST, there would not be a case of reporting.
Yes, sir. Correctly pointed out. Even our technical guide on tax audit, I think Parrot 23 or Parrot 26, if I remember correctly, it's Parrot 23, talks about this kind of a reconciliation statement. It even gives us a format of how do we prepare a reconciliation statement, both under the inclusive method, under the exclusive method, and preparing this reconciliation statement with a justification that the profit under both the mechanism is on par is where a tax auditor responsibility gets fulfilled. So that is what Parrot 23 of guidance note provides for. Yes, as you rightly pointed out, we may still have a challenges when it comes to obsolete items, slow-moving items. So that might be one area, but otherwise, in general, under both the inclusive and exclusive method, except for a small timing difference, because a closing stock of 1 year will definitely be opening stock of the subsequent period.
Right.
So if you just ignore the timing difference, then the profit element would be same both under the inclusive method and under the exclusive method.
Exactly.
Very well explained. Yeah, I'll take up one more question. Quite interesting. How should the amount of inventory pledged as security be presented in the financial statement? Does pledge also include hypothecation or other encumbrances?
Right. So, see, below inventory basically is the item, in this sense, is the item which we are referring to from the balance sheet perspective. Okay. Now, in the balance sheet, wherever you are giving the inventory note, like we saw in one of the presentation, that my raw material is this, my goods in transit is this. Below that note, there is a sub note or an explanatory note which says that my inventory is pledged for purpose of bank finance, and since the bank finance amount or closing amount would also be there in the short term borrowing, you can cross refer that particular note where there would be a complete disclosure that what is the security against the short term borrowing. Now, it may so happen that I have pledged raw material, I have not pledged finished good. So that you can give it a clarificatory note. The note could itself be worded like that, that out of the above inventory, the raw material has been pledged for the so and so borrowing, and refer this note for the entire terms and condition of the borrowing in short term note. The second part of your question was about the encumbrances. Normally, if there are encumbrances which lead to any reduction in cost or something like that, we normally take it into account or account for it. But like as an investment, in the Schedule 3, Division 1 and 2 clearly says, particularly in case of investment, that if there are encumbrances on the investment, the same has to be disclosed. Inventory standard does not specifically point out to the encumbrances, but I think it would be, if there is any material encumbrances, drawing a corollary from the investment note in Schedule 3, we should disclose the encumbrance.
Yes, sir. I think it's a good practice because when the word what they've used is a pledge, so hypothecation or encumbrance is almost similar to that. Yes. So as a good practice, we should ensure that even if the stocks are hypothecated or encumbered, then even those details have to be provided in financial statements.
Yes.
The next question, again, you had explained it earlier, but since it has come from the participants, I'm asking you again. What are the practical challenges in allocating fixed and variable overheads to inventory, especially when the production capacity fluctuates? To add on to this, if you're preparing a quarterly financial statements, how often do we have to do these adjustments?
Right. So this is a very common question. So friends, we have to be very clear in our fundamental. The word that the entire India that is used as a reporting date. So whatever the principle that is applicable for yearly filing, until and unless you are exempted for doing certain things, which we are, the review, quarterly review is also your reporting date. So if you have to value inventory, it is not an annual jalsa, it is a requirement. So it is like quarterly also it is a requirement because you will have to determine profit. So that adjustment has to be done in the quarterly profit as well. Now, what are the practical challenges? Let me tell you the best way what I have practically observed because I think, Mr. Prashad, the point is we are here to discuss more from a practical perspective. So I'm sharing my practical thought process. See, for every industry, the type of work which you do from quarter to quarter or year to year would be in a similar fashion. You would be following some trend. The best way is when you have made your first draft of the financial statement. In that particular first draft, you have to make a template that what are all your costs, okay, and what is gone and sold and what is the remaining inventory. So those becomes the two columns. Now, basically, for dividing that, you need to have two things, which is one is the normal capacity and one is the actual production. So, actual production is normally there. We do not have anything called as a normal actual production would be there. I really appreciate the problem with regards to the normal capacity. Friends, I understand the normal capacity is very difficult to determine because, say, suppose you have a service line or you have a assembly line. If you put more than one person or if you employ two more person, the capacity could double or it could halve. So, broadly, see, estimate again is the only thought process. Lot of leverage is given to the promoters, to the management of the estimate, and there is lot of guidance given to the auditors how to evaluate the estimate. So the capacity calculation is an estimate, but very important estimate. Since guidance auditing standard give you guidance with regards to estimate, how do you have to audit the estimate, and the guidance is also there for management that in the financial statement, the estimates and those things have to be disclosed and given if it is at all there. So wherever there is a material estimate which can make and change your opinion or it can have a different opinion, those have to be accordingly disclosed. So summarizing what I discussed is, yes, normal capacity is a challenge, but you have to again apply some rational basis from time to time and calculate it. And as an auditor, you have to be very cautious about it, how to measure those estimates. Anything you would like to add?
One small thing is like, yes, you rightly mentioned. So it is an estimate. It's a game of an estimate. And actual production, I come to know at the end of the period. If it is quarterly financial statements, yes, at the end of the quarter. If it is yearly financial statements, at the end of the year. If the variance is not material, we may actually route it to the P&L account. If it is material, then we may have to go back and adjust to our stock. So
Yes, materiality point of view is also right.
okay, the next question, which is very interesting, which is Ind AS 2 applicable to service industry. So was it there even in accounting standard too?
Yes. So, interestingly, ICDs also have one line that it is applicable to service industry. Broadly, what I've understood is yes, it could be applicable. There's no distinction that it is applicable only to this. So you have to go to the definition of inventory. So spare parts, consumables. So consumable could be only the possible inventory in a service industry. Normally, since the benefit is not over a period of time, so you can have that consumable. So whether a very large amount of consumable left or which you use in your service industry, can that be considered as a part of the leftover inventory or the stores? That is always a question. Yes, we can do it at times. We have done when it is material, but normally it is not applicable in service industry.
Okay. Uh, Fine, sir. I think there is
That's
one.
my. We do not have any specific guidance, but my view is like wherever there's very material leftover or very high amount of uh, maybe items which you might not be able to consume in a year, maybe in those cases. Otherwise, generally it is all expensed off.
Yes, one small thought from my side. So basically, there is a paragraph in Ind AS 2 which talks about in case of a service provider like chartered accountants and a law firm, etc. With respect to the work what we have completed. So they have a guiding principle saying that you can go ahead and recognize the amount of work what you have done, but only thing is you cannot add on the profit element while recognizing the work what you have done.
Yes, from that aspect, yes, I missed.
Yeah. So there are one or two practical questions, so which I require your thing. Before that, since we were working on tax audit and Caro reporting, could you help us understand the disclosure requirement in relation to inventory from a Caro perspective? There are two clauses which are applicable. So one is basically to what extent we can rely on the management when it comes to management thing on inventory valuation. The second thing is management is expected to file a quarterly returns with the banks or financial statements whenever they have a working capital. And as an auditor, we are supposed to report saying that whether their financial quarterly report submitted to the bank is not significantly different from the actual financial statements. Your practical insights into this.
Yeah. Yeah, the Caro reporting is in itself very important. Clause 2 has two subclauses. The one clause, the first clause about physical verification. So, interestingly, it has 5 questions incorporated in it, which is sometimes maybe missed out. Maybe for oversight in FRRB, we also had those items. So there are basically 5 questions. The first is whether physical verification is carried out or not. So that's a simple answer. Now the second is whether it is done at reasonable interval. Now, what is a reasonable interval? Again, it is a point of judgment. Of course, there is a respite in it. The Caro itself says, or rather, the guidance note gives that a yearly uh, minimum at a yearly basis. So even if a company has done on a yearly basis, probably all the plus minus would have been incorporated and accordingly the things would be there. So at least yearly. But if the type of the inventory, like say for in retail or other things, other type of industry, then it is very important to have it on a periodic basis, which is a judgmental call. Now, the other two things wherein which I like to add, though it was not specifically in your question, it is about the coverage and the procedure adopted. Now, this coverage and procedure adopted is also very, very important. We, as an auditor, you have to comment on the coverage. Coverage means how much inventory is covered or not. Okay. And second is what is the procedure adopted. So we have to be very clear about both the term. They consider it as a different question, not one question. Now, it may be so that one of the part of the coverage or one of the part of the procedure is not as per desired or level, or it has some issues. So even an auditor can comment on one of the aspect. Like say, suppose the coverage was nice, but maybe 5% of the inventory was not done, or 10%, or a one particular location was not done, or the procedure adopted, the procedure was fine, but basically you can say that the records of the communication is not done on a formal basis. So wherever there is any issue or wherever there is any lack on coverage or procedure, those can be also a sub part of the reporting. The lastly is if there is a 10% difference in any class of inventory, then that has to be reported if there is a discrepancy of more than 10%. So that is one part. The second B point with regards to the banking clause, which is there, where you have the limit. We all know what was the flaw. People used to, or companies or entity used to give the stock statement on 25th of March or 28th of March, and all sort of things were happening. Now the only requirement is the clause is very self-sufficient in itself. We all understand what is the requirement. The fundamental is now actually we should go and ask for the statement that has been submitted to the bank, and basis that find out what is as per books of account. If there is any difference, report it. So I think the clause is very clear in itself.
Very good. I think in the interest of time, I'll be able to take 2 to 3 more questions. So one is in relation to price change, which happens retrospectively. So I made a purchase in the month of April. Subsequently, somewhere in the month of August, I get a price change in relation to those purchases. How do I basically do an accounting? In 2 scenarios. One is if I've actually sold that goods. The second scenario is the goods are still not sold. It is lying with me as an inventory.
Yeah. So let me analyze the point. So I have already made a purchase. Okay. Now the purchase is, say, suppose at a price of X. Okay. Now at a subsequent date, what happens is I get a price reduction, which could be either negative or either it could be positive price change.
Yes.
So in both these cases, the commercial way of doing is that you either get a debit note or you get a credit note. These are the only 2 ways. Now, basically, it gives us a challenge of, I'll quickly answer this, I'll not elaborate much. So, broadly, the problem is with not the accounting, I suppose. Broadly, the problem would be with the GST portion. Now, I cannot do the price change without the credit note or the debit note. And once this debit note or credit note, it has to be accompanied with GST. So as and when I think if the credit note or debit note is reflected in the GST, then I should account for such debit and credit notes. Now, the problem is, say, suppose if I have sold the good, I think that aspect was covered in the presentation. So in case whatever you have sold, and if there is a reduction in the price, that goes to your profit. If there is an increase in price, that goes to your expense. And if it is lying in the stock, then you have to adjust in the stock. So these are the possible. So the important problem in case of price changes is by way of credit note or debit note. The problem is the accounting should happen at the point when you get the GST credit note or debit note. That is my point.
Yes, sir. Understood. Okay. Sir, in the interest of time, I'll pose the last question.
Sure.
Which, as a practicing chartered accountant and accountants, we all know, whenever we want to play around with a profit, I think the main or the important item which we all look upon is a inventory. So valuation of inventory has always been a tool for tax planning or tax profit planning, if I were to put it bluntly. So, as an auditor, what are your views? How effectively one can conduct an audit, or one can safeguard when management is trying to play around with the stock figures for tax planning and profit planning thing?
Right. Friends, I think no question can be important and relevant than this question. In my last 30 years, I think there has never been an audit which has a stock and there was no discussion on the valuation. There would be always a conflict between conflict of, I would say, conflict of duty, I would say, from the point of view of auditors and from the point of view of the management. See, fundamentally, we have to keep one thing in mind that if you are auditor, you are required to do the correct thing. That is the fundamental. Broadly, there has to be a valuation as per the accounting standard. The valuation has to be correct. The only problem is whether we'll be able to justify the valuation what we have audited or not audited. And what is important for the management also, whether the management is having a proper records of the inventory or not. So let us take it this point with so I divide my answer now, the further part of the answer, in two parts. In the larger company where there is SAP or there is an accounting software, the entire information can be extracted, and any playing around with together with the audit trail issue, you can come out with this situation. The only benefit what management can get is with regards to some estimation points, maybe it could be 1, 2, 3% or something like that, which every time practically we also might not be able to justify. But if there is a reasonable way to do it and circumstances are there, then you may accept the management estimate. Again, when we are auditing an estimate, there are certain guidelines that are given, and accordingly, you have to follow those guidelines. And friends, we have to have the audacity to put our foot down wherever there is anything going wrong with regards to particularly the larger entity. Now, there is a practical problem in case of SMEs where either the stock is manual or maybe by some smaller accounting programs and all that. There, yes, you have a challenge of information and you also have a challenge for estimation. So, therefore, we should not bow down. We should look at a practical aspect, how it can be valued. And you have to actually educate the management that by doing anything wrong, they are just they would be just postponing the tax liability. It is not that they'll not be taxed at any point of time, number one. And number two, the IBC cases have clearly shown us that riding on a lion, once a small lion and then a larger lion, whether that would be justified. The non-material item may maybe you might overlook, but not overlook, I would say non-material item may not be part of the audit overall, I should say a very tight compartment. But anything which is material, and in case of a stock, it would be material, it has to be tightly done. You need to put your foot down where you are not satisfied, and you have to really educate all the clients, all the auditees, that what is their roles and responsibility, what is our roles and responsibility, and help them to have a system of what you call inventory management. And I can tell you, this is a very short term measure if somebody does it. In long term, this doesn't help at all. So, yes, practical problems are there in case of MSME, but you should educate the client, make a system, get them do what is right.
Yes, yes. Yes, sir. I think well explained topic. We had a wonderful time for the last 2 hours. Thanks for the knowledge. Thanks for your time. Okay. Now I extend thanks to the committee members, Shri Sanjeev Singalji and Vishal Doshiji, leading the stage, and thanks to all the torch bearers, all the members working in the ASB for giving us this opportunity. Hope all the participants had a wonderful learning experience. Any questions, we can always route it through ASB, and speaker would be more than happy to address that. Yeah. So I think with this, we could end the session today. Thanks again to each one of participant in the program. Thank you.
Thank you, Mr. Prashant. Thank you, Rahul. Thank you, ASB. Thank you all.
Thank you. Rahul, we could end the session now.
Thank you so much, sir. Yeah. Sanketji, please end the session. Thank you so much.